And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. The wild markets are placing new emphasis on ETFs that are tactical in nature, that is, those that are not tied to indexes and can quickly allocate and reallocate resources. Let's talk to one of those managers. Katie Stockton is the founder and managing partner of Fairlead Strategies. She also manages the Fairlead Tactical ETF, and also with Troy Donohue, he's head of America's portfolio trading at BTIG. Katie, before I ask you about your ETF, you're a longtime active manager. I know I've known you many years. Just tell us, what are you doing now and what are you advising your clients?
Well, there has been a very distinct loss of long-term upside momentum behind the S&P 500, and with that, some of the sectors that we like to invest in have fallen out of favor. So what we try to do is help investors leverage the upside through sector rotation, but also minimize drawdowns. And that's obviously a big advantage longer term when you can just go into a less deep hole to climb out of. So with that, we have the ability to use asset allocation to manage risk, not just that sector rotation.
Yeah, so your tactical ETF, TAC, T-A-C-K, symbol folks, just passed the 3-year mark. That's important right, because people look at benchmarks. 1 month, 1 year, 3 years, a typical important benchmark. Now you rotate between the 11 S&P 500 sectors, these equity sectors, but you also have gold you can rotate into, and long and short-term treasuries. And I know it rebalances every month. So where is this invested now? Right
now it leans defensive, but we still have an 87.5-ish% exposure to the equity market, which is remarkable because we've managed to outperform the S&P 500 by a good measure this year despite that nearly full equity exposure. And we've done that through more defensive sector exposure. So we own consumer staples, utilities, real estate sectors, whereas we don't own technology anymore. That's a new sector that we've removed from the portfolio because of its loss of long-term momentum. And we took that position and we put it into gold, we put it into the short-term treasuries, which is our sort of cash equivalent, and then also long-term treasuries. And it's that diversified risk-off exposure that can help us outperform.
So this is fairly defensive when I look at it. So you, consumer staples and utilities are there, and you have a small weighting in long-term treasuries, 4.5%, short-term treasuries 4.5%, gold 4.5% here. No holdings in tech, as you mentioned, but it's still almost 90% stocks, 87% or so. Is that going to change at all?
I think it will. So it's a model-driven fund. It's 100% systematic. So we developed the model over the course of years and took our indicators, collected them to arrive at conclusions about these sectors. In 2022, when the fund launched, it went to just one sector with a 12.5% position. And that means we held the 87.5% in those risk-off categories. So it has that ability to really be dynamic, not just among the sectors, but among those other categories. And that's helped it over the long term minimize the drawdowns. Every drawdown more than 8% in the S&P 500, TAC outperformed both the S&P and its primary benchmark.
You know, Troy, let me bring you in here. There have been a lot of attempts at developing tactical ETFs out there. There's some fairly large ones, and even in the $3 billion range. I know First Trust has one, Pacer has one. But outpacing the S&P 500 has really been very difficult in the last few years. What's the issue, and under what conditions might a tactical fund outperform?
It's a pleasure to be here with you and Katie.
Thank you.
We actually worked together for a number of years.
That's right. Katie was at BTIG for a number of years.
Right. It's good to see you.
She was always well renowned for her technical analysis, so it's great to see it in an ETF product that has performed really well during this recent drawdown. TAC is a great example of how you can be nimble during these market times, and these tactical funds have the ability to rotate very quickly and move into positions that might otherwise be longer down the line. So we've had a big run up in the last 2.5 years, and investors were sitting in more beta products. Now we've had this dramatic pullback, and investors are looking to protect capital and make sure they don't have these big drawdowns in their portfolios.
But it has been tough being a tactical manager for a long time now. I mean, if you just sit and own the S&P 500 basically for since the financial crisis, really you've notably outperformed. I'm an old Jack Bogle disciple, everybody knows that, and Jack used to talk about mean reversion, that it's a very real thing. We're finally getting a little bit of mean reversion maybe not so much in the bonds, but we're getting some mean reversion in the markets. Certain global markets are outperforming. Defensive sectors have been doing well for a good part of the year as well. That's contrary to trend. That's certainly nice to see. It's a vindication of the mean reversion crowd at this point, but still, it's been tough.
Yeah, it's certainly been very tough, but I think these are the times where tactical ETFs can differentiate themselves and show that their approach and their diversification from the rest of the market can help benefit investors in their portfolios, because they can provide those asymmetrical returns and help avoid some of those big drawdowns that we've seen.
Yeah. So Tati, I just want to say, your strategy would underperform if tech was dominant, which is what we've seen in the last few years, and it would outperform if the market was dropping and bonds were rallying, for example. I'm just trying to get a sense of how it would outperform.
Yeah, and I would comment on the active versus passive management. The active management, think of it as dynamic, right? So it will respond to market movements, and that's important, especially if you can miss the 2008s or even the 2022s, you will be at a long-term advantage in your portfolio. For those that do have that long-term time horizon, that's really very appealing. So TAC, if it has, by the nature of the equal weight sector positions that we carry, it will be by default underweight technology when it owns technology, which we owned from most of 23 through 24 up until very recently. So that natural underweight position would suggest that in the strong tapes that are tech-led, we would have TAC as a core holding and supplement it with other technology exposure. Usually the questions we get mostly about are technology stocks, right? So they can go buy Netflix and Microsoft and supplement those core, more boring positions, but they're lower beta, lower correlation. And even in a very strong tape, there is some benefit for financial advisors to have products that do have a lower correlation to the S&P 500, just from a risk management perspective.
But give me a sense of what you're thinking right now. So it rebalances every month. Is it the beginning of the month?
Yes, right at the beginning. So we wait for that month-end closing data to check the integrity of the models and the indicators, and then we recalibrate usually the first couple of days of the month. And with that, we reset to 12.5% sector weightings. If we had a full sector position, we would have those, all 8 buckets filled with the sectors, but we will morph into that more risk-off exposure as the market warrants it. So
in this case, did you own tech at some part in the year?
We did, yeah. We just removed tech in March.
In March, so April
March.
Now,
we have no more
technology sector is not in there, and you have weighting to gold 4%.
That's right.
Long-term treasury 4%, short-term treasuries.
Yeah, and we would expect to see that grow just because of our market call, which is for more of a prolonged bear cycle, during which we will expect those alternative asset classes to outperform. That includes gold, which we've already seen develop, but also the treasury market is better suited to us right now than the equity market in terms of risk reward. And we're talking about maybe not the next 5 years, but maybe the next year or so, that's going to be the case. So we're very comfortable with that natural shift.
And this recent move in the bond market's been a little perplexing, though. I mean, bonds down, yields up. You would think the other way would be happening
if
there was a concern about a slowdown.
It's a trading range. If you look at yields,
Yes.
zoom out, you'll see a trading range there. And yet the safety and the yield that they offer, I think, will be relatively attractive to what we're finding with the volatility increase on the equity front. So we find appeal there, but like you said, international, for those funds that do move into international markets, there's appeal there as well. The relative performance has shifted meaningfully behind some of the developed global markets. So there's a lot of opportunity, but right now it isn't what it looked like in 23 or 24, where it was so mega cap centric. And for advisors, they really can't afford to have a super mega cap centric portfolio in terms of the risk that they carry with that, right? We saw the shift very dramatically out of those names as of December, and it's become very real.
Yeah, but I want to go back to this diversification part, Troy. And diversification hasn't been terribly successful in the last few years. I mean, just owning the S&P 500 really has been enough. And now we see global markets outperforming. So as I said, mean reversion is a very real phenomenon, even if it can take a long time. In your fund, it wouldn't necessarily show up, the international diversification, but we're seeing it in the ETF space certainly right now. There's been inflows for the first time in a while in some global bond funds, or global stock funds.
Yeah, we're seeing global stock funds gain assets, and people are really looking at different parts of the world to see where they can diversify their holdings. I think whenever you get types of pullbacks like we've seen, investors will look at their portfolios and see where they can reallocate or rebalance to make sure that it still aligns with their investment needs and goals.
Yeah. And how do you align it with investment needs when nobody's owned international for 15 years? I mean, it's hard to, again, we go back to Jack Bogle, he would argue under what circumstances do you want to own international? Jack often said because 40% of the revenues occur outside the United States, or the earnings, excuse me, you have some international exposure in the S&P 500, but most people would argue, 10% exposure to an international equity fund would be normal in a diversified portfolio. Yet I know a lot of people don't own anything international at all and haven't for years.
I would say that the key is that you shouldn't have a static weighting in any one asset class or region. It should be related to the strength of that region, whether it's coming from momentum, price momentum like we use as our primary input, or fundamental or macro inputs. So a more dynamic allocation, something that can replace the traditional portfolios. Maybe those portfolios were 60-40 or something like that.
Right. But that assumes that price momentum is a long-term successful strategy over long-term buy and hold market cap, and that's debatable, of course, as you know. It's been
it's my day job, so I'm biased.
I know, obviously, but you get my point, Troy.
Yeah, absolutely.
Right? I mean, again, Jack would be smiling down, saying, "Bob, you think that you know when to go in and go out of these things," and that was his fundamental beef with technical analysis in general.
I think technical analysis got a very good reputation in 2008, and it was a time at which the technicians really turned a lot faster than.
Well, in 2002, the dot-com bust, the technical analysts were screaming long before the fundamental people were.
That's right, and that's where when volatility goes up, the demand for technical analysis goes up as well.
Yeah. And just because an ETF is actively managed doesn't mean it can't utilize a rebalancing schedule. I mean, you in theory, every month actually look at this thing and
we
rebalance.
believe in long-term investing. So to use month-end closing data, we're eliminating a lot of that intra-week noise that the market suffers, and we're with that,
it's very disciplined, active management. It's not like, Katie wakes up today and something's telling her,
the emotional biases would get in the way. Then it's really very math-driven, frankly, measuring price momentum, measuring relative performance, measuring overbought, oversold metrics, and all of that taken together formulates the portfolio.
This is a very good point she's bringing up about behavioral biases, because one of the things we find out is one of the reasons people underperform is behavioral biases literally infect their thinking. Literally, behavioral biases throw your thinking off. Things like overconfidence and too much trend following throws your. So your point is having a mathematical formula rather than you getting up saying the tea leaves are not going in the right direction is the right way to go.
Listening to the market, responding to its movements rather than trying to be predictive, and acknowledging when those movements are great enough to suggest there's been a major change. That's what we're trying to respond to, and of course also at the same time finding those opportunities when the market becomes disjointed like it did very recently. So being there to take advantage of the upswings when they come.
Yeah. Troy, there's also fixed income tactical ETFs. I know we've been talking about equity ones, but State Street, for example, has a fixed income sector rotation ETF. The symbol's FISR, Frank ISR. And they rotate. Essentially, they just go back and forth between short and long-term treasuries, mortgage-backed securities, high yield, and corporate bonds. So it does exist in the fixed income world as well.
Yeah, absolutely. Even though most of the assets in tactical ETFs are equity products, there's sector rotation, there's country rotation, factor rotation, there's cash toggles. There's also those same strategies employed in fixed income ETFs. And so you're seeing that today where they can quickly maneuver out of certain products that aren't in vogue that they think won't perform as well in the near term.
Yeah, there's been some arguments. I've had some active fixed income people come on and argue when I bring up this, how difficult it is to outperform by switching in and out, that tactical bond does better than tactical equities for some particular reason. They seem to want to believe this, that our track record as active bond managers is better than the track record of the active equity managers. I'm not sure that's necessarily true, other than that there's billions of different CUSIPs out there for bonds, and you have a lot more choices that you can trade around on. But they have made this consistently, this argument, for a couple of years now.
Well, I hope Katie will prove them wrong on that front.
I appreciate that, Troy.
It's a tough game.
Well, you're able to access people like a Jim Bianco, who I know has a tactical bond fund. You're able to access these very smart people through the ETF structure, which also has much lower fees generally than either mutual funds or hedge funds private products. So I think that's such a gift with these actively managed funds, to be able to get access to these managers. And then on top of that, with that nice tax wrapper that the ETF structure provides for a sector rotation strategy like mine, if an advisor is trading in and out of the sector spider ETFs as much as we do, they would incur a lot of taxable events. Yeah,
it's a good point. Folks, very interesting discussion. Again, tactical has come in, active management as well has come back in as a interesting pressure point in the ETF business. That does it for this week's ETF Edge. My thanks to Katie and Troy. We have asked Troy to stick around and provide us more perspective on ETF trends this year. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.